All right, what's up, everybody? We haven't started yet officially. We have about maybe 7, 8 more minutes to go. Big shout out, Alex Popova is in the house today, just for everybody to know. T-Roy, Tyro, Schumann. Folks, let us know where you're tuning in from. We're going to start in about 8 minutes. Make sure that you're paying attention. This is the Sunday Stock session that we do here with Matt Maley. We're giving you a sneak peek into the thought process, the analysis, the setups that we're doing in the live room. So make sure you're paying attention also, because we will be talking about possible trade ideas for the next week. And if you do want to trade with Matt, we're going to let you know how you can do that. We're going to show you his strategy. We're going to talk about the 2023, what's happening in 2023, how you should trade, and what you should be focused on as traders, right? So let us know where you're tuning in from. We're going to start in about 8 minutes. Schumann from Pittsburgh, what's going on? In Visledge from Arkansas. Let's go all over the world. Just go ahead and put on where you're tuning in from. We'll be starting in a few. Good to see everybody. Happy Sunday. We haven't gotten this started even. What's up, Mr. Barr? We'll see you guys in a few minutes. And make sure, pen and paper. This is an important session. We'll see you in a few, guys. All right. Mic check. Mic check. Is the mic good, everybody? Javier, Invalid Pledge. Let me know the mic is good. We're going to be starting here in a few minutes. What's up, Masab? Good to see you here, my friend. So we're going to be starting in a few minutes here. I just want to check in. What are you guys looking at in the markets? Is there anything specific that you're looking at in 2023? Do you think inflation is going to be as important as it was this 2022? Do you think the Fed is going to impact the markets? Do you think earnings are going to push it up? What do you think is going to be that 2023 yearly trade topic, subject, if you will? Geopolitics, Taiwan, who knows, right? Let's get a feeling for what you guys are looking at in the markets. But we will be starting here in about 2 minutes. We got some people from Colorado. What's going on? So Kevin says inflation is here to stay. I think Matt Maley will agree with you. Inflation is, I mean, people are not going to be dropping the prices. They're obviously going to keep it there. But that's unfortunate, right? That's inflation. It's not transitory, right? Like they said. And we're going to talk about all these things as well. But that's a really good answer there, Kevin. Don't be shy, folks, to participate. The whole goal of this is so that we learn, we trade together, we analyze the markets together, and more importantly, we get Matt Maley's opinion. Chief market strategist. He's been in Wall Street for about 40 years officially, and currently chief market strategist at Miller Tabak. Kevin says oil will play a part if it goes higher. What do you think about smart contracts and Ethereum? We'll get Matt Maley's opinion on crypto. Don't worry about that for sure. We always do. Matt rocks, absolutely. Jason coming from San Antonio, Texas. Yeehaw, let's go. So we're going to be starting here in a few seconds now. Matt Maley, I believe, is in the house. Just to give you a brief introduction of what we will be doing. We will be talking about trade ideas, setups, education. What else? We're going to talk about the type of trading. Matt Maley does like volatility trading, basically buying calls and puts. It's what most people do nowadays with options. They're just trading it. Kevin, earnings seasons. Yeah, earnings season always plays a role. So yes, trade ideas, options education, market discussion, Fed analysis, rate analysis, inflation, sector analysis, micro and macro strategies. We will be covering a lot. And at the end of the session, we will be going over some trade ideas from you, the chat members, just to keep in mind what the schedule is of what we will be going over, right? We do have a couple people here. We do want to give some shout outs, of course. DW is in the house. Nico, Normandy, Mike, Krishna, Golden, Daniel, Mr. Fondue. We got Dave Fondue here. I see you there, man. All right. B. Edmund, good to see you here again. Fame Bay, Kevin S, C-Roy, Promo, Tanner, T. Davis. What's going on, T. Davis? All right. I think at this point we're all good to go. What's up, Mr. Fondue? Now let me just make sure here everybody on the YouTube is good. Henry's in the house. Jesse Hernandez is in the house. Patek, Rick Anderson. Let's go. Let's go ahead and bring on Matt Maley. I think that he's somewhere in the back. Let's give him a proper introduction, of course. 1, 2, 3.
Damn, son, where'd you find this?
All right, so we have Matt in the house. Can you hear me?
I can. Can you hear and see me?
Yes. Yeah, I can see you, man. So yeah, Matt, this has been a crazy week. I know that's really what you guys look for, volatility in the chat room. Before we do get started, though, Mr. Phil Harrison is in the house. I see you. But before we get started here, Matt, let me just ask the chat members really quick. If this is the first time that you're in one of these sessions, right? Put a 1 in the chat. Put a 2 if you've already been here before. And I know a lot of you have already been here before because I recognize your names in the pledge. But Matt, for those that are watching, and we'll let the numbers come in. Keep in mind, folks, the more we actually get to see if it's the first time or not, we'll know how to guide the conversation so that we can please everybody if that's even possible. So Matt, for those that are watching here for the first time, I know your extensive background on Wall Street. If you can give us a brief introduction really of your wholesome 40-year experience in Wall Street for the people that are watching here for first time.
Sure, Rodrigo. My background is a lot different, I think, than most strategists on Wall Street. In fact, pretty much all strategists on Wall Street. Most of them are former economists or former sector analysts, and of course, there's nothing wrong with that. We want economists and good economists and good sector analysts, but they tend to deal a little bit more with the theoretical side of the business and what should happen. And they also look at a very long-term picture, and that's good too, because we want to always want to look at what the long-term picture is. But mine is that of a trader. And it gives me a better idea of what, not just what theoretically should happen, but what is happening and what's going on in the real marketplace and what is going to happen over the near term. So and near term, intermediate term, and longer term. And I just think that gives me a big advantage, again, because I spent the first 25 years of my career. I've been doing this 4 decades now, but the first 25 years were on the trading desk at 2 of the biggest firms on Wall Street. The first 15 years were at Salomon Brothers. If any of you are not familiar with it, they were in the 70s, 80s, and 90s. Salomon Brothers was the premier trading desk, the most powerful trading desk on Wall Street, it was even, Goldman Sachs was probably the biggest, most powerful firm overall, but on the trading side of things, Salomon was definitely there. Now, I wasn't there in the 70s. I was there for 15 years in the 80s and 90s. And then after that, I went to spend 10 years on the trading desk at Merrill Lynch. Obviously, one of the most powerful and the biggest trading in terms of size, the biggest trading desk on Wall Street. And when I was doing that, I was covering the biggest institutional trading desks on Wall Street. Not just the biggest mutual funds, the biggest hedge funds. And not only that, the biggest mutual fund and the biggest hedge fund, Fidelity and BlackRock, but also banks, big banks, insurance companies, et cetera. And you really get the idea of what these people are looking at on a short-term basis. And because even the biggest long-term players, they're when they're buying and selling securities, they want to know how it's going to perform and how they can get the best price for their customers on a near-term basis as well. So again, on a short-term basis, we can't think about where it's going to be 3 or 5 years from now, or even 6 months to a year from now. We got to think about where it's going to be in the next few hours and the next few days and next few weeks. And that really gave a leg up. And it also gave me the understanding that traders, people who want to be active investors, they really need to be trading with other people. You're at the biggest hedge funds in the world, biggest mutual funds in the world. You're talking to other people on your trading desk, smart people who are in the markets all day long. That's great. Not only that, but you're getting calls from every single broker on Wall Street, whether it be the top 50, even the top 100 firms are calling you all day long saying, hey, did you see this? Hey, did you hear this news? Or hey, did you hear this rumor, et cetera, so that people can know what this. So in other words, the biggest and brightest with the best money, the biggest money in the world, they're trading with a team of people that are helping them. So if they're not trading alone, how in the world is an individual trader going to be able to trade alone? So that's what's really one of the reasons why we got involved here with Benzinga in this chat room, so that people can come together and not be stuck trying to just trade alone and guessing on too many things, and make real good educated decisions rather than wild guesses on how to do things, especially when it comes to the short-term stuff.
Right. So lesson number 1, don't trade alone. I hope everybody's paying attention. We'll see a lot of golden nuggets that'll be thrown out here and there, but that, I guess, is probably one of the most important lessons here. Matt, so I think we can go. We have a lot of ones here, a couple of twos. So we do have a lot of people watching here for the first time. And I guess this is great because you really don't complicate things. You're not doing spreads or butterflies, but let's go ahead. You're just buying calls, buying puts. It's very simple, easy to follow. Let's go ahead, and if you don't mind showing your screen, and a lot of people are asking, what is Matt Maley's strategy? If we can show some examples because ultimately every trader the people that are trading options, they would like to do it in the way that you do it, but there's a lot, it's not just buying and selling. There's a lot more that goes behind the scenes on this strategy that you've developed for the past 40 years, right? Exactly.
I'm sorry. I was just, I got my, thing. I just want to make sure I get at the stuff so you guys can see what we're talking about. Okay. And obviously what we want to do obviously today, so you give you an idea of what we do, how we do it, what we're thinking about, when we're doing it, and the success that we've had this year. Those are the don't worry, I'll blow this up so you can see it a lot better than this. But what I try to do, and let me just move this Here we go. Sorry about that. I just want to get this stuff better situated so you can see it a little bit better. Anyway, what I do is, again, everybody, when I was saying about how some of these theoretical issues and the fundamental factors that go into the market, I mean, we always want to care about that, and I care about it very much. So we're thinking about those long-term fundamental issues, but we're also looking at technical analysis very, very closely. And I've said so many times in the past, all of the best active managers, all the best hedge funds, the biggest guys, all of them use technical analysis extensively. Paul Tudor Jones, Stanley Druckenmiller, Steve Cohen, all these guys. Now, I'm not saying that's their primary use at all, but it's something that they use extensively because it is a very important tool. It is actually based on fundamentals, which some people who haven't taken the time to really learn it, just kind of say, oh, it's just a bunch of lines drawn on a chart. But they're not. They're actually fundamentally based, because if the market moves, as we all know, the market moves 6 months in advance, or an individual stocks move 6 months in advance of its underlying fundamentals. Why wouldn't you, if that's what it's going to tell you, why wouldn't you use technical analysis to tell you, so you can see what it's telling us 6 months in advance, right? So we use that. We use sentiment readings, which I'm going to show you today is going to be very important for things like gold. I'm very bullish on gold longer term, but near term, it's getting a little overloved and a little overbought. And we'll talk about that later on. Use positioning, et cetera, so that we can see the key turning points on whether it be on a short-term basis or on a long-term basis. I mean, we're, I think, at a key turning point here in the dollar. But a year and a half ago, actually over 2 years ago now, I caught the key long-term turning point in the price of crude oil back in October 23, right on the money, and long before anybody else did, because we combine all of these different aspects of the marketplace. Because if you're only using fundamentals, as I said, if you're only using the fundamentals, the market's always right. That is true only to a certain extent. The market is only always right eventually. Okay, we've had many times the market has been dead wrong for months at a time, or certainly weeks at a time. And same thing with individual stocks. So we try to combine all these different things so we can get these key turning points, because that's where you get the most of your juice. But and then when we do it, we can do it in stocks, ETFs, et cetera. But we here in the chat room that we have been involved with for about a year and a half now is something where we do concentrate on the options. And as Rodrigo said, we keep it simple. We're not doing a lot of complicated things. Once in a while, we'll do some strangles or some straddles, but mostly it's just buying puts, buying calls, and trying to take advantage of these moves. Now, here's the best one. The number one we ever had was here on the Chinese market. And that's one of the things that I try to focus on is not to narrow my focus. Yeah, we want to concentrate on the U.S. markets because that's what we know best. But there are so many things. We've made money in commodities, wheat futures. Wheat options on the wheat market, on the Chinese stock market, which I'm about to show you, on the high yield market, on the dollar, on treasury options, etc. And that's the thing is today, which we didn't have 10 years ago, and we had them 5 years ago, but they weren't very active. They weren't very liquid. But now we have the tools. We have these ETFs and inverse ETFs and leveraged ETFs and options on all these things. And we have not just options that are quarterly options that we used to have to trade for years. Now we have weekly options and even daily options, depending on the major indexes. So we have the tools that only the big institutions had in the past. So we try to combine all these things and help us to make some real nice profits in the options market, even in down markets. Last year was a great year, even though it was a really tough year for most investors. Now, this is the first example we had, and I like to kick off with that because it's the biggest winner we've ever had. I wish we had winners like this every week, but this is the FXI. It's the China ETF, and last March, we came in and we bought this. It says last week's chart. That's just an old chart. It was last week's chart when I wrote it. But you can see that the FXI, this China ETF, have become ridiculously oversold. See how I've been making? I was negative on China all the way down here. It was making lower highs, lower lows, all the way down. The Chinese government was clamping down on their in different industries. But then in 2022, we came in. The U.S. came in and said, "Hey, we're going to delist." We're thinking about delisting some of your companies, and the market, their stocks just fell out of bed, and so they didn't mind doing this to themselves. But boy, They did not like the fact that we, the U.S., had a big impact in just creaming their market. Well, that's when I came in. So I knew, so using a couple of different things, technical analysis, I used the RSI. For those who are not familiar with it, it's a relative strength index, okay? And it tells you when it gets down here to the 30 level, the green line, that means it's getting oversold. That's why it's a green line. It says, yeah, it's getting oversold. Go ahead and buy. It's oversold. The red line is at 70, 70 reading. That's red line for it. Stop. Don't buy it up here. It's getting overbought. And you see when it gets below the line, it's even, gets extremely, extremely oversold. A really good opportunity to buy it. Well, look at this one. You see it gotten oversold here. Good time for a short-term buy. Got oversold here. Good time for a short-term buy. Here, same thing. Here, look how ridiculously oversold this was. This chart only goes back 2020. I went all the way back to as far back as the FXI went, which was 20 years. Was by far the most oversold reading it had ever seen. So I took that technical analysis and said, this is a great opportunity to buy call options. And we went in, we bought them. Now, though not only that, I used my 40 years of experience to know that whenever China thinks they're losing face to the US, the government's going to come in and buy their market, and they're going to push it higher, not just for a couple of days, they're going to push it higher for a while. So we came in and we bought the calls on this, on this back. Okay, so look what happened, right? The FXI, huge rally. The next day, it rallied 27%. It dipped the day after that, but it was still up 27%. That'd be like the Dow Jones Industrial Average rallying 27% in one day. Well, needless to say, we had bought those puts. It was a huge home run. We came in on March 15th, okay, on March 15th of last year, and we bought the March 18th. This is the expiration date. So in other words, that's not the day we bought them. This is the expiration date on the option. But we came in with specific trade. We didn't just say, hey, China's oversold. You ought to think about buying some stocks. We said, no. This is an unbelievable opportunity. Let's get in and buy a specific option. We bought the FXI, March 18th, $30 call option. So we gave the exact expiration date, the exact strike price, obviously whether it was a call or a put, and then of course at the very beginning we tell you what the security is. But here we bought them late in the day on the 15th, and look how much they took off. The next day with that huge rally in the stock market. Now usually when an option takes off, it opened up 1,000%, and I'm like, usually I'd say 1,000%. Oh my God. Let's not get greedy. Let's just take it. But I knew from experience that the China government would be in buying their market overnight when they were in China, but also through the day in the U.S. buying the stocks that were listed here. So I held off for a while. And then by about 11 o'clock, I said, oh my gosh, these things are up 3,000%. You got to use some management. I mean, risk management. That's an important thing. And I said, I can't. Boy, if this thing goes back down, I'll never forgive myself. So we went ahead and I put into the chat room, hey, we're going to take profits on half. I said, hey, listen, I still think this is going higher because I think the government's going to push higher, but we got to take some profit. So we sold half, almost 3,000% gain. Okay. And then later in the day, we rallied all the way into the end of the day. And I said, oh my gosh. I said, again, it's probably going higher, but now that it's up 8,000%, I got to take the rest of it off the table. So you take the two halves. We made over 5,000% in just one day. And there were other people, though, who listened to what I said about saying it could go even higher and held on longer and made as much as one person made 11,000. One person even said they made about 14,000. I can't take credit for that because I had taken profits before that. But I think the people who sold early, as Baron de Rothschild said 150 years ago when he was asked, how did you become so wealthy? And he said, because I always sold too early. So that's what we did. But that's just one of the examples. I'll give you one or two others here. I mean, obviously, I'd love to tell you that we do that every single day. We're making 5,000%. That's just not the case. But we do make some, here was a situation, and we make it on a consistent basis. That was in March. Then we came into May, and we were buying, again, we're in the middle of the bear market. The market had seen a short-term bounce. We came into the QQQs. Okay, we bought the May 2nd $320 puts. Now, again, the trade date here was April 29th. So we were going out a little into the future a little bit. But again, in one day, in the same day, we made 215%. Again, I was like, I'm not going to get greedy. The market's coming to a close. When you make 200% in just a few hours, we're going to jump all over that. And then, again, we're trying to, do this on a consistent basis. Here's another one we had in May. We move into May. The market had become oversold on a near-term basis. I was bearish throughout pretty much all of on a general basis. I was bearish the entire year last year. I started at the beginning of the year saying you got to raise cash. This is going to be a bad bear market. Got to be careful. I said it was going to be a deep decline, and then as soon as Russia invaded Ukraine, I said it's going to be a bear market. However, there were times where I said, hey, no matter what my long-term concerns are, the market's oversold. It's ripe for a bounce. Sure enough, we came in and bought the TQQQ calls. The TQQQ is the leveraged ETF on the NASDAQ 100, the QQQs, right? So this is TQQQ. We came in on the 12th. The market was oversold on a Thursday. I said, these things are expiring tomorrow. They've got to rally. Here we go. TQQQ, May 13, $29 calls, 600%. We bought them at 3 o'clock on one day. By midday the next day, we sold for 600% gain. So again, I just want to show you that we did that in May. And then, here's a situation in Apple in the same month where Apple Computer, remember when the commodity, the cryptocurrencies were getting creamed, right? There was basically, it was a panic in the cryptocurrency market. There was margin calls. People were being forced to sell. Those markets weren't liquid enough for them to raise enough money. So they sell what they could sell. Now, these guys who own the cryptocurrencies, they didn't own General Motors, right? They owned Tesla and Apple and things like that. Those were the things they could sell to raise their money because there weren't enough bids to hit in Bitcoin or especially in Dogecoin and some of these other things. So they said, well, you've got it. And the brokers tell them, you got to sell something, either that or pull the money out of the bank. One way or the other, you owe us the money. So what did they do? They started selling Apple. Apple went down 10% in a week with no negative news. I'm like, I understand that the markets are interrelated, but Apple doesn't go down 10% because Bitcoin is crashing. It's just not, they're not correlated that strongly. But it was happening because Apple had become a source of liquidity. And I realized this from my experience. I'd seen it during when the bubble burst back in the dot-com era, et cetera, when long-term capital management went under. But so I saw this. And then finally, on May 12th, the crash in the cryptocurrency ended. But Apple went down again. And I realized these people are not, the stock, people don't realize that there's nothing wrong with Apple right now. Okay. And so we came in late that day. I realized that the forced selling was over in the cryptocurrency market. I knew the cryptocurrency should bounce a little bit, but I knew Apple, which had nothing wrong with it, was going to bounce in a big way. Sure enough, late in the day, we bought the Apple May 13th, 143 calls, 400% by midday the next day. So, and again, I'll go through some others. I don't want to kill you with all these things with AMD. So we do it with AMD. We did it with Apple. It's individual stocks. We did it in the ETFs, the QQQs. But I just want to show you because there's an XLE. Here are the XLE. We did it in both ways. Whoops, we're just here. We did it. Oh, well, let's do it here first. We do it in both ways. The oil market. Remember how I said how I love the oil market? I turned really bullish. Well, I rode that. Even though I was bearish on the stock market throughout all of 2020, I stayed bullish on the energy stocks, and the energy stocks took off. But at the end of May, they started becoming way too overbought, and way too overloved in sentiment readings. So I said, you know something, we're going to go in and we're going to buy the XLE, which is the ETF on the oil energy stocks. We're going to buy the June 17th, $19 put. Now it was June 8th. We went out more than a week. Okay. We bought the $90 put. Sure enough, a few days later, the energy stocks got rolled over. We sold half of ours at up 400. Well, the first half we sold it up 500%. The second half of the position we sold up 470%. So about a little over 500% gain. Again, that's a 3-day gain that we made there. So again, you see how we do it. Individual stocks, we did it on the QQQ, on the indexes. We did it on the energy stocks. So some ETFs. Here's the one where we did it in wheat. Here is the WEAT. It's not because I don't know how to spell. It's the wheat. That's the symbol for the wheat ETF. And again, we have the tools. You don't have to call up the Chicago Board of Trade and open up a new account, commodities account. You can just do it with a regular trading account, a regular options account, and in any of these dealers. And we went in, we bought the July 15 $9 calls. A couple days later, they were up 250%, because remember when commodities took off in the first part of the year, then they crashed in June and into July. They became oversold on a short-term basis, and we took advantage of it here. Here's another one in July with the TLTs where we made 230%. This is on the Treasury bond ETF. So we're looking for wherever the LABU, LABU. Here's a sector thing. We did it on the XLE. This is on the LABU, which is the 3 times leveraged ETF on the biotech stocks. Okay, here in 2 days, we made 800% on those. And I just want to show you here by running through these September. So we do it on a consistent basis, and we can go over some that we've done a little bit more recently in the last week or two. And we made on Friday when we bought some puts in Delta, some puts in the bank stocks right before their earnings, et cetera. We're doing this on a consistent basis.
We'll go over some of the more recent trades, and just to kind of just recap here really quick, folks. So we did a quick lesson on RSI. We talked about the price action, risk management, global markets, ETF trading strategies, lesson on energy and commodities trading technicals, lesson on wheat and commodities. So we definitely have already gone through several different lessons, as well as risk management, which is very important. Also, a lot of price action analysis that you do. Now, before we move on here to the next segment, let's show them a couple more recent trades, but I do want to highlight some things here. Mr. Dave Fondue, Matt gives winners every day, lifetime Inner Circle chat room here. Dave Fondue is great. I remember, he's set up in the chat room. M. Del Sesto, I'm a member of Matt's chat room. He made a great call on gold recently. We were watching it and then moved on it. Yes, personally, always high. Right. Yeah. So, I mean, there's members here in the chat. That's great. You guys can see what they're saying. So before we move on to the next segment here, Matt, show us a couple of recent trades so that people can see that this is not a random thing. And then we'll go over to discussing a little bit about the overall markets and that sort of stuff.
Right. Yeah, I definitely, because this is what's going to happen in the near term is very, very, very interesting. And I'll show you these near-term trades in a second. But is that because I'm really excited about going over what's going on in the marketplace right now, because there are a lot of different things that could happen in the next week, in the next week or two. The markets are bumping up again. I am continue to be bearish, and I'll tell you why. I'll tell you why in a while. Bearish on an intermediate term basis, and I think this market's going to roll over soon. But we are bumping up against key resistance levels in the S&P, the NASDAQ, and the Russell 2000. If they break above those levels, we could see another big move to the upside before things roll back over. And I want to be able to take advantage of those. That's the thing. Is these people sit there and say, again, there's nothing wrong with having that bucket that's long-term and you go, okay, I'm putting that away. I'm going to buy Apple tomorrow and I'm going to look at it again. No problem. But if you are one of those people who like to be, do it a little bit more actively, you can take advantage. You can see how it was. Is that when I bought those puts on the XLE energy stock ETF, I bought the puts, make a negative bet. I didn't sell any of my energy stocks. I stayed with those. I was just trading around my long-term positions. Okay, that's what we want to be able to do because we have the tools to do it nowadays, and it's worked very, very well for us. But here's some of the trades that I'll show you from just last week. Here it was, Delta Airlines. Okay, you see how it came out? We bought at the end of the day. I kept saying that here's the stock, and people were asking, what's with Delta? And I said, we talked about it earlier in the week in the chat room, saying these stocks are getting overbought, and I'll show you that in a second. But I said, let's hold off because let's wait till the earnings come out because the market's holding up real well here, and the time value will make them make these put options cheaper as we move through them. Well, sure enough, you can see what happened here. They reported earnings the next, and see how the stock fell out of bed. The next day, we sold part of it. This was last week. I'll say so. We bought them late on Thursday, and sold a bunch of them right here. I've held on to a little bit more. It bounced back. So, now they're not worth as much as they were here, but they're worth more than they were here. And again, let me just go on to what I was looking at in Delta Airlines. See how overbought it become? We talked about that RSI, relative strength index. See how it's, see how the stock got overbought here and sold off, got overbought here, sold off, overbought here, sold off. These are all short-term sell-offs. Well, this was a longer-term one, but see, it was even more overbought. So I knew this thing, well, I knew, but I thought this one would come down quite a bit, and we were able to take advantage of it. The same thing happened in the bank stocks on Friday. Again, let's go here. Well, okay, now this was a little bit different. Look at how overbought JP Morgan was. Overbought, but not crazy. Okay, not crazy. And so I was like, but, okay, then hold on for that a second. I mean, let me just hold on to that thought for a second, then I'll bring up the intraday charts. These things here, this is a GIP chart. It's just gives you what happened over the last 2 trading days on Thursday and Friday. This was Thursday, this was Friday. Well, this is what we did late on the day. I actually bought the Bank America option, so you can do it, but we were talking about Bank America, Citigroup, Wells Fargo, and JP Morgan. So let me just pull up Bank America, because that is the one I chose. But we were talking about it, and a lot of people bought, some people bought puts in all of them. But again, that was Friday's action. And here is, boom. Okay, here we are. So see what happened here. Now, the reason why I bought those puts, and you say, well, look, at the end of the day, well, we sold a bunch of puts right here. A lot of people sold all of their puts. I held on to some of my puts. I still feel comfortable with them because I bought them out to next Friday. But the thing is that the group, for whatever reason, tends to sell off after they report earnings. It's been going on for a couple of years now. And the group had seen a nice, strong rally. BAC. Even though it wasn't, Bank of America wasn't crazy overbought. Even though it wasn't crazy overbought, it was getting overbought. And see how it was rallying into those earnings. I said, it's got to see a pullback. So, even though it bounced back at the end of the day, we sold them on the opening. I do have to admit, most of the people in the chat room sold more than I did. I held on to some, but I still feel comfortable with it. I think they're going to roll back over, and I may buy some more on Thursday, because sometimes this group does bounce around a little bit for a day or two after they report earnings, and then they go down. It's the strangest thing in the world. Even when they report good earnings, the group gets hit. It's the craziest thing, but it has worked very well, and we worked and it worked very well for us on that. Let me go back to this my thing here. I'll show you a couple other examples. Hold on 1 second. Oops. Here we go. Okay. I just want to go because I'd like to give more. Oops. No, that's not what I wanted. Believe me, I will show you Bitcoin very, very soon. Here it is. Oh, shoot. Okay. Here we go. No wonder. Okay, those are the sum temper. Well, let me go back to this thing here. Let's go back here. Let's go Tesla. Okay, we've done extremely well in Tesla. Oh, no wonder. There we go. Okay, now Tesla has been one where we saw what was going on. I did not like Tesla. Okay, here was the stock up here. I said, especially if it breaks 200, I'm going to get rid of some of these lines here so it doesn't look so darn busy. Those are the moving averages, the 200-day, the 100-day, and the 50-day. But anyway, see how the stock was getting killed here. But it was this key. I really felt that, going back here using technical analysis, that the $200 level was going to be the key support level, right? And bang, bang. And of course, when it broke below that level, I said, we got to buy some puts. So we made over 200%. Some people made over 300% of their on the puts on this one right here. When it got down to here, I said, people are saying, should we, in the chat room, are saying, shouldn't we be, the stock just looks like crap here. And I'm like, well, look at it. It's getting oversold on its RSI chart. I think it could bounce back to the 200 level. So if anything, you should look about buying some calls. Sure enough, obviously the stock moved up nicely. We made a nice profit there. But I said, this is going to be a failure. And again, look at the fundamentals, what was going on with Twitter, what was going on with Musk, what was going on with with China, with their orders being down, et cetera. This has got to go lower. So it came all the way down here. We made a couple of different trades along the way here. Again, people making more than 100% on their returns. But look at this one down here. It's getting down. It was getting down towards 100. Looked like it was going to get to 100, but look how oversold it became. Incredibly oversold. I came in and said, nope, we got to buy the calls on this now. I wish I had the chart here for you, but we'll pull that back up. But the point is, we made, again, I made just under 300% on the Tesla calls at that point. Other people made just over 300%. Mine was 285%, I think, to be exact. But again, I just saw that it doesn't matter where it's going. To be honest with you, I think the stock's going below 100, and I can talk about that in a minute. But the point was, even though it was only a 2-day rally, I knew it couldn't keep going down at this point, especially as that round number, $100, that should provide some sort of support psychologically, if nothing else. And sure enough, it only bounced for 3 days, and we took advantage of it. Rolled back over. And again, we've been bouncing around, trading around with these. But just this last week, again, we were looking when it got back down to 100. We bought some calls there. The stocks rallied. Now, I am saying now, though, I don't think this rally is a good one. This most recent one of the last week. The one on Friday, the announcement they had to cut, they're cutting prices by 20%. That is a huge sign of weakness for this company and on a fundamental basis. No, I'm not saying they're going out of business. I'm not saying Elon Musk is a knucklehead, that he's lost all, he's lost any chance he has of pulling. No, none of that stuff. They are still at the forefront of EVs, and I think the company will do fine over time. But when you have to cut by 20%, and we're now in a situation, let's face it, Tesla, a big part of why they did so well, its stock, was because the excess liquidity that existed, the massive levels of excess liquidity that existed in the second half of 2020 and all of 2021 from the Fed. Okay, that made their gains way outsized. Well, guess what? That era is gone. Okay, right. What the Fed has been, we'll go back onto that a little bit more later, but the Fed has taken that money away. This stock, and if their fundamentals are starting to deteriorate a little bit, the stock has got to lower before it finds its natural level. So this is going to present a great opportunity to buy some more puts. But again, we want to be able to trade on both sides of it. That's what we've been able to do, and we'll continue to do. I think we'll continue to do in the future.
I don't know if you remember the last time. Well, we had a session, and I had mentioned that Tesla, and this was in December, they did a rebate. So basically they were getting, this was in December, right? So they were like, everybody that buys a Tesla this month will get $3,500 off the full price. Now, January, you're seeing that they cut prices for all the cars, right? Like big time. So
20%, yeah, huge.
Yeah, so I think the good thing here is that, look, it's not like we just found out about Tesla. You've been trading in and out of that you've been doing this for 40 years. So listen, we have a lot of questions here about the live room, Matt. Let me go over these really quick before we can actually get back into the conversation. I know we have a lot of other things to cover, including the new 2023 financial crisis. In the meantime, while you get your thoughts there, Matt, let me go over this, and then we'll jump back into this. All right?
Sounds great.
Does Matt Maley go over student trade ideas, member trade ideas? Yes, good question there, Jeremy. Actually, we've had some really good trades from the members, including, I think it was a 2,500% on, I think it was Amazon calls. Tiffany, a member from the chat room, I remember she shorted Roth last year. That was about a 4,000%. So Snapchat was another winner. So members are always posting trade ideas for Matt to review, and ultimately you'll get the strategy. You'll be a mini Matt Maley. So we're always trading together as a team, as a unit. And that's really good. That's what you want, right? Let's see. Are the sessions on Tuesdays recorded? Yeah. So Matt Maley does a session every Tuesday. It's from 11:30 to 12:30. It's only for the chat members. It's about 30 minutes, 35, 45 minutes around there. And that started as a 10-minute session. And then Matt Maley, he's just very passionate, if you haven't noticed. And then now it's like a 45-minute session. And that's all Matt, okay? That's all Matt doing that as a courtesy for you guys. So yes, you will have that recording. Let's see, is this for new options traders? Yes, this is actually great for people that are new in options, because you're only buying calls and puts. You're not doing anything complex. You're not doing covered calls, condors, butterflies, diagonals. You're trading the volatility. So what is the chat room schedule? The chat room is open 24/7, but Matt is there from about 8:30 a.m. till about 5 p.m. That's Monday to Friday, chief market strategist on demand, posting entries, posting exits, and we do have those notifications going out. You can access this from a phone as well. Let's see. Price at renewal is the same as today, unless you get a lifetime that doesn't renew. Does Matt provide education? Yes. So today we provided some education, and we're not even done yet. But in the Tuesday meeting, Matt provides education segments as well. And also every trade that he's posting, he will tell you why he's making that trade. So this is active trading education, if you will. It's different because, as an example, Warren Buffett's top three opinions on how you should trade really don't apply to you as a retail trader who's trading the market. You're not investing for 100 years. You're trading for the day or the week. So that's why the education that you get here with Matt is tailored to what you're doing, to the trading that we're doing. Good question there. How much capital is required to do these trades in the chat room? So Melanie, these calls and puts that Matt is buying, these are like 70, 80, 90 cent contracts. So they're not really big lots, and it's easier to average in and average out and practice risk management when we do it this way, because we don't just have one huge contract, right? You have different contracts that can be spread out. So CTG, is there a daily session? So the daily session with Matt is in the chat room. He's live the whole day. But Tuesdays, it's a Zoom call. It's a private call. So that's for the chat members, CTG. If anybody does have questions, the link is posted in the chat where you can email me and we can see, how this works for you and stuff like that. Or you can call, we'll put that link there in the chat. If you want to join, we do have that link posted in the chat. Matt, is there anything here that you think I might be missing, just to kind of move on here to the next segment that we've got?
No, yeah, I think just that the thing about the Tuesday Zoom call that we do, it's at 11, I think you mentioned 11:30 Eastern time. And I thought it would be something we'd kind of be a little tutorial thing, and we'd cover, 10, 15 minutes. And it's just morphed into a much bigger thing, because, the people in the chat room are very inquisitive. And so we use a little bit of a tutorial thing, because some of the stuff I'll talk about, it's like, that doesn't really make sense. It's because a lot of the stuff, some stuff in the marketplace is counterintuitive. It's not all that, it's not hard to understand. It's just counterintuitive. And so until it's explained to you, it doesn't make a whole lot of sense. Once you explain in a right way, it becomes more obvious. So in other words, it's not like calculus where you're going to take 6 months of study or whatever, weeks of studying it to understand it. It's just about, that makes sense now that you put it that way. So we like to talk about that, and then we talk about what's going on at that time. What are the good ideas? The situation we're talking about. We're looking at the macro picture, and then we're looking at the individual situations. So it's a great learning time for people. A good time to ask questions, and sometimes they'll say, "Hey, this is something I can't, I can't seem to get my head around, and I know you can't answer it in 3 lines in the chat room. Can we talk about this in the Tuesday Zoom call?" Absolutely, and that's what we do. So it works out really well.
Yeah, and I don't know what's the last time somebody here really had that kind of access to a chief market strategist, but let's just to recap here: 3 to 5 daily trade alerts in the live room, Monday to Friday, 8 a.m. till 5 p.m. That's when Matt is there available. There's a member-only meeting on Tuesdays. And as a bonus, if you sign up while we're here, you will get 6 email trade alerts. And these are stock swing trade alerts. These are not options. As I think we've kind of covered this, but Matt Maley is also able to help you with stocks, not just options. Several people in the chat room have asked, Matt, what are the 3 stocks that I could hold for 5-10 years for my kids' college fund, or buys and holds? And how do I trade around certain stocks that I own? Like, there are people that have energy stocks like Matt, that maybe they don't want to sell their energy stocks, but they want to profit from the swings. That is something that you can yes, he is a chief market strategist. Matt doesn't only look at US equities, he's looking at global equities. That's why Matt really brings a lot more to the table. That FXI trade, that is a Chinese ETF. I've never heard of that in my life. So Matt is also able to bring these things, trading the dollar, trading different things out there, wheat, commodities. It's more than just stocks, folks. Even treasuries, TLT, all these different types of instruments. So we'll post that in the chat. And yes, wonderful Sunday. So Matt, let's let's rip right into this, okay? Yes, everybody has the information on how to join your live room. We'll go over, if anybody does have questions, put them in the chat. But what is do you think is the main 2023 financial crisis? What do you think is going to be happening this year?
Well, I mean, the biggest thing is that we are moving away from this whole. There are way too many people on Wall Street, and most of them are paid to be bullish. That's kind of their job, but they're too focused on inflation. And don't get me wrong, I'm not saying you shouldn't be focused on inflation, but the problem is inflation was last year's worst problem because interest rates pushed the market higher because inflation was high, right? But the next part of this process is going to we're in the beginning of a normalization process, and people just are missing the boat on this. The next problem is going to be the downturn in the economy, and we don't need to have a serious recession to fall into to have the stock market fall a lot more than it already has. Okay, now. I mean, first of all, earnings are going to come down, and I know people say, "Well, everybody's saying earnings will come down, so they won't come down." It's like, no. Earnings. It's the thing when people get too far on one side of the boat. That's only if they get positioned that way. If the market's set up that way. If the market's pricing it in. The market is not pricing in lower earnings because it's trading at 18 times earnings. All right, that's the high end. That's an expensive stock market. And when you look at this price to sales, it's 2.3 times sales. That's what you usually see at market tops. Forget about market bottoms. Okay, the market is still very, very overvalued. And the reason is the Fed's liquidity from 2020 to 2021 pushed the market so high, okay, and to such overvalued level, it's got to fall further before it gets back down in line with its normal fair value. And of course, whenever a bear market comes, it usually overshoots to the downside. But more importantly, the people don't understand. Too many people are thinking we're going to go back to what we had basically since the great financial crisis, where it's like, hey, if the Fed pauses, that means we're going to have zero interest rates and quantitative easing. Well, that's not the case. It's not the case. If the Fed pauses, all that does is keep interest rates at a certain level. They're telling us, the Fed keeps telling us, pounding away, and then you get these college professors who say they're crazy, they're going to have to lower rates. Well, maybe they'll lower them a little bit at some point. But everybody is assuming, because it's human nature, that we're going to go back to what we've seen over the last, recent past, the last 10, 12, 14 years, that we're going to go back to ultra low interest rates. The Fed is telling you, they're not saying it's going to stay up near 5%, even if it comes down a little bit, it's not going back to zero. Okay, and we're not going to, I'm sorry, and the Fed is saying we're not going to inject all this quantitative easing, all this liquidity. So no zero interest rates. We're not going to have zero interest rates, and we're not going to have this massive excess liquidity pushed into the markets. That means valuations have to come down. The only time you can have valuations at 20, 22, or even 18 or 19 times earnings is when there's artificial liquidity, artificially low interest rates, not just a little bit lower, okay, artificially low, below where the economy is, and a QE program or an injection of liquidity. It can be a QE program, or it can be something else. People don't understand the same thing. This is very, very similar to what we saw in 2000, okay? In the late 1990s, the Fed and all the global central banks flooded the system kind of behind the scenes, but they flooded the system with liquidity because of the Y2K issue. If you remember those Y2K, when was it 1990, 1995, 96, 97, 98, 99, 2000, 00. Okay, all the computers were going to turn 00. The problem was all the computers in the world were going to, that 00 was going to tell them it was not 2000, but it was 1900. And of course, so all of those bank accounts would have reverted back to what they had in their accounts in 1900, which in 99.9% of the cases was zero because most people weren't alive in 1900, right? So this was a major, major problem. They saw it well in advance. And in the second half of that whole decade, they flooded the system with liquidity so the corporations would have the money to spend to fix that issue. And you can talk to anybody who worked in the technology side of any company. You tell them how they'll tell you how important that issue was. And they did it. It worked. They fixed it. But they also flooded the system so that markets would stay high, so that people wouldn't panic about losing their money in the banks. As you know, not all the money's in the bank. It's it's a fractured banking system. So if everybody comes at once for the money, there's not going to be enough there, right? And so they flooded the system with liquidity. It's not a coincidence. Everybody, back then they were saying everybody loves the new economy. No, it was a flood of artificial stimulus to save the system from Y2K. And sure enough, once about a month into 2000, when they realized, yep, now they didn't want to do it on January 3rd. Oh, it's working. Let's make sure it's working for a while. Well, sure enough, about a month and a half into 2000, they said, okay, everything's fine. They pulled the liquidity from the market, and the NASDAQ topped, and that was the end. And it went down 80%. Okay, and the same thing happened this time around. We had massive levels of liquidity injected into the market in March of 2020 because the global economy had all but completely shut down. All right, so they realized that if the economy completely shuts down, the whole global economy, the market's going to shut down, the whole system's going to shut down. So they flooded the system and they pushed the markets up artificially. Everybody knew in the summer of 2020 the markets were artificially high. They're like, we're okay with that because at some point, the economy will reopen and it'll come back up. The problem was the Fed kept the liquidity spigots open, and as it never was able to catch up, it kept pushing higher. Those are the only two times we've had 20, 22 times earnings. And in fact, in 2000, it got up to 30 times earnings. Okay. The same, so you see a situation that was really not a new economy. It was not all the new initiatives. It was all this massive liquidity. Guess what happened in 2000, 2001, 2002, 2003? Horrible bear market. How bad of a recession was it? It wasn't a bad recession at all. It was one of the mildest recession in history. Okay, and yet the stock market, S&P still fell 50%, and it took 3 years for them to unwind it. Okay, 2.5, 3 years. Okay. So therefore, those are people who keep talking about, don't worry, the economy is going to be okay, inflation is going to be okay. That's fine, but we're still trading at 18 times earnings. Every bear market in history, well, every bear market since World War II. I haven't looked since, it's probably true from before World War II, but every market, I haven't looked further back than that. Every market, every bear market, and certainly every bear market that had a recession, not all bear markets have had a recession, but every bear market has seen the stock market fall to at least 15 times earnings. Okay, at least in many cases lower than that. So if you get to 15 times earnings, that takes the market to 3,400. Okay, that takes the S&P. Right now it's at 4,000. It's got to drop to 3,400. Even if we had a mild recession, even if we get a soft landing, which is basically what we got in 2001 and 2002, it was a very, very mild recession. It was a resetting of valuations levels after the massive liquidity injections were taken away. That's what happened in 2000. That's what's happening now. It's going to take longer. But so even if the economy does go through recession, which I think it is, because there's so much debt in there, where the situation is much worse than it was in 2000 because we have record levels of debt, the market is going to come in. It's interesting. If you get a chance, you look at the MaleyReport.com. It's something I talked about. There's a free edition of it that I published this weekend, the MaleyReport.com, and I go through all of this stuff. It tends to be long. It's a weekly piece. During the week, I send about a page and a half, more of a short-term play, but it just goes through this is exactly what I was talking about last year, December and January of last year, where I was pounding the table saying, you've got to raise cash. This market's going to go down, and we were headed for that. All these idiots who were saying, "Don't worry, the interest rates will still be okay. It doesn't matter." And I was like, "No. Every single time the Fed raises interest rates, it causes at least a deep pullback, and usually a bear market." That's exactly what happened. Same thing's happening now. Now, look at this chart that I have up on the situation here. It goes over what I talk about in the Maley report this weekend. Everybody's talking about, inflation's coming down, so we're going to be fine. And that's wrong. You go back to every time interest rates have rolled over from a sharp increase, it's negative for the stock market. Now, what are you talking about, Maley? Wait. I've been watching the markets for 10 years or 20 years. Every time interest rates roll over, it's actually bullish for the stock market. Well, it is when a rise in interest rates is only short. It's maybe a month or 2 or 3, and it's in the middle of a stock bull market. So then when interest rates roll over, the stock market rallies. However, When it happens in a bear market, after a long-term rise and a very sharp rise in interest rates, it's actually bearish, because what happens is when it's just a short-term rise in interest rates, okay, no big deal. When it's a long-term rise in interest rates, it causes a bear market. And when it rolls over, you got to compare apples to apples. When it rolls over, it's signaling that we're going into recession, okay? And every single time, now I only go back to 2000, but I'm telling you, it's true for every single example going back to the 1973-74 bear market, okay? And I didn't go back further than that, but here he said, but here it was. In May 2020, interest rates were going up, going up, going up, and sure enough, they rolled back over. Did the stock market bottom in May 2020? I'm sorry, May 2000? No, it was just at the very beginning of the bear market. Same thing happened in 2007, May 2007. Again, it was only the very beginning of the bear market and interest rates, because they told us interest rates were going down because we were headed towards a recession. So therefore, instead of lower interest rates being good for the stock market, they were a bad indicator for the stock market. Same thing happened in 2018. November 2018, interest rates started rolling over. The stock market continued lower, fell another about 10%. That year was not a bad bear market. It was down 20%, 19.8%. So it's not officially a bear market, but for all practical purposes, it was. But the point is, when interest rates rolled over, that was a negative sign, not a positive sign. The same thing happened in January 2020. You know what happened then. Of course, that was a little bit of a unique situation, obviously, because it was the COVID. But you see, everybody saw that what was going to happen to the economy. And therefore, in January, when those interest rates rolled over, okay, now it doesn't really look like much, but they actually had rallied quite a bit here. But when they rolled over, it showed us we were going into recession, and the market dropped 35%. We're doing the same thing here. After a sharp rally, we're starting to roll back over. That if this is any history, and I'm telling you, it does go back all the way to the 70s. The same thing happened in the early 1990s, in 1980s, and mid 1970s. Same exact thing. When interest rates rolled over, again, after you have to compare apples to apples. When they rally when they move up in a big way, cause a bear market and a recession, then they roll back over. And when those times, it is negative for the market. Now, here is CPI. Everybody's talking about CPI. Well, inflation's topped. Well, that's great. Well, in the 1970s and 1980s, when inflation topped, it was very good for the stock market. And that's when all the textbooks were written. And that's why all these professors who have never spent 10 seconds on a trading desk are talking about the fact that inflation's topped out is a really good thing. Well, okay, great. But look what happened in 2000 when CPI, this is what the number we had last year, CPI topped out in 2001, okay? The stock market fell another 30%. In 2008, inflation topped out. The stock market fell. I mean, again, yes, when inflation comes down, it will be positive eventually, okay? But near term, it's negative because it's telling us we're going into a recession. Same thing happened in 2018. In 2018, CPI went down. The stock market continued to go down. And of course, look what happened when the CPI fell out of bed in 2020 during the pandemic. The stock market fell out of bed. CPI going down like it is now is not, just think about it. It's common sense. I mean, these guys on Wall Street they're paid to be bullish. The vast majority of them are paid to be bullish. That's what they do. Okay. And they are, but it's like, how could, they're flat out saying demand is coming down, and that is going to take inflation down. Okay. Well, if demand is coming down and a consumer-related economy, I mean, consumer-driven economy, 70% of the economy is a consumer. How can that be good for the economy? I mean, so you're saying, yes, demand's coming down. We're going into slower growth. We're slower growth in an expensive stock market. If growth is going to slow down, earnings are going to come down. Every recession since World War II, earnings have turned negative. Every one. Okay. So even if we have a mild recession, earnings are going to be negative. That is bad for an expensive stock market. If the stock market was trading at 13 times earnings or 12 times earnings, like it has at most bottoms, I'd be saying, don't worry about it. Don't worry about it. It's already priced in. Those people who are saying it's priced in are just making it up. They're saying that because they're paid to be bullish, because you can't say it's priced in when the market's trading at 18 times earnings and 2.3 times sales. I mean, you can't fake sales. You can play around with earnings, PE ratios, because earnings, you can have write-offs and these things. But your revenues are your revenues. Unless you're flat out lying, you go to jail for that. Your sales are your sales. And when it's expensive on the sales side, it is not a good situation. So these are the things that people, I just don't. Now, here's another situation. People, we have this is the DXY dollar index. It's breaking down to a new low. And people are saying, well, that's good. Well, theoretically, it's good. And people say, well, geez, if the higher dollar last year was negative for the stock market, the lower dollar must be positive. Well, I understand that. And again, the textbooks will tell you that. And they'll also tell you that international companies, their earnings will improve as the dollar gets lower. And that's true. But the inverse correlation between the stock market and the dollar is very uneven. It's about 50-50. There's been many, many times where they both moved in the same direction. And as you see, you've been seeing lately is that the European stock markets, emerging markets, they've been outperforming in the last several months. People are after over a decade of the U.S. market outperforming. Everybody is overweighted U.S. stocks. I'm talking about global investors, not just ones in the U.S. They've got to be looking at these other issues. So I'm sorry, these other countries, because they had such a bad year last year. If this outperformance continues, I got to start shifting some of my money over there, whether it be in Europe, which is a much cheaper, even though they've got some issues, some serious issues there. It's trading at 12 times earnings. 12 times earnings. Ours is trading at 18 times earnings. Hello? Okay. And if the dollar is going to move lower, that's good for emerging markets. People are going to shift that money. So if the dollar moves lower, it depends why the dollar is moving lower. If the dollar starts to move lower because people are selling, are selling dollars and buying euros and other currencies to buy those stocks, the lower dollar is going to be negative for the stock market, not positive. Okay. Let's see here. I'm sorry. I just
really quick here, Matt. I just want to give a shout out here to Tammy and Mike, the new most recent family members that joined here from this session.
Great. Thanks for joining. I think you'll. Again, in the coming weeks, we're going to be really active and really doing some stuff. Last week was kind of interesting. We were not the most active in the world. We did do some nice trades, but because a lot of people were waiting around. What was the CPI number going to be? What was the earnings going to be from the banks? So like Tuesday and Wednesday were kind of quiet days, but we can't. That's one thing. I'm not forcing things. If we're not going to do it, I think there was one day I actually didn't do a trade, which got to be a first. But you can't force it. If there's nothing going on, or if I don't see anything, there's always something going on, but you don't catch every move. And I can't force the markets to move. And everybody was sitting there waiting for these important reports. So let's not just piss money away. Let's just wait and see what happens. And so that's sometimes the, but boy, we got a lot of earnings coming out. And things are going to play really well. But one of the real good calls, I know Rodrigo had mentioned earlier, gold. Everybody's talking about gold now. I mean, nobody was talking about it back at Thanksgiving when I was talking about it. But I talked about how it made a very nice base. Okay, everybody said, forget gold. It's not a hedge against inflation, whatever. But back even before Thanksgiving, it broke above its trend line after performing that nice base. So we turned more positive on it. We've been talking about it. But I did say, some plays in here where people made some plays. I really got more bullish when I broke above 1800 because we made a nice higher low and then a higher high above that August high. That was very, very bullish. Okay. Now it has made another higher high and really broken out to the upside. But, and we bought Barrick Gold. I'm sorry, this is gold. Okay. There's also Barrick Gold, which symbol happens to be GOLD. This right here, I want to make sure everybody knows, this is not Barrick Gold. This is gold, the commodity. But we had gotten in, we bought some silver stocks, some silver miners, a couple of silver miners, Barrick Gold. But now I'm saying, hey, let's not chase them. And look at this. It's very, very overbought. See, again, the RSI, it's not crazy overbought, but we also know that sentiment amongst the futures traders from the readings that I look at is above 90% now. When bullishness gets above 90% in the futures traders, that's a short-term warning flag. So I love gold longer term. I love gold intermediate term. I may be. We bought some puts in the GLD, which is the gold ETF, but very, very, very small. Next week I'll be looking to add to that. I'm not selling my gold positions or my silver miner positions. But what I am going to do is trade around the positions because it is so overbought and too overloved. 2 months ago, nobody was talking about one of the very few people talking about bullish on gold. Now everybody is. And it's got too many people have gotten to that side of the boat on a near-term basis.
Right.
So it's going to pull back, and we're going to take advantage of it when it does.
Well, I remember when you were talking about gold during these sessions and in the chat room, kind of reminds me how you were one of the few ones that was bullish on mining many years ago, on metals and mining. And that's kind of what it comes down to, Matt. Like you'll post something, you'll have an opinion. And then just like you were since 2022, I've been watching you when you go live on CNBC and Bloomberg. You have been consistent. You don't let anybody steer you from what your analysis tells you. And even though everybody, like 95% of the people on TV were bullish, even though they were down 90%, you were consistent with your strategy, consistent with what you viewed was going to happen in that market. So you seem to be very early on these plays. You've been doing it for 40 years. Is there a particular, do you have a time machine, or what's the deal here?
Well, yeah, I mean, it's like anything else. We're not right all the time, and we certainly have been wrong. And you've got to be able to adjust. When the facts change, you've got to be able to adjust. And I'll show you in a second what I'm looking at right now that might lead me to believe to get a little bit more bullish on purely a short-term basis, not an intermediate-term basis. But yeah, I'm a contrarian at heart, but at the same time, the people get too caught. It's human nature to see what's happened recently and project it into the future. We do it with, it's not just the markets. We do it with our favorite sports teams, whatever it happened. The weather. Oh, the weather's nice. It's going to stay nice. It's just weird. It's kind of the way human nature is. And all of these people who have made, the Stanley Druckenmillers and the Paul Tudor Jones and these famous hedge fund guys, they're the ones who saw the top when everybody else was bullish, or saw a bottom when everybody else was bearish. And that's really what I try to do is look at these times when things get to extremes. So much of Wall Street, people are trying to get the 70% in the middle. That's fine, and there's nothing wrong with it. And for your long-term portfolio, that's really the best way to play it. But one of the reasons why nobody turned bullish on crude oil, they were only 3 months late. They all turned bullish in January of 2021, but they missed half the move. And again, they were still up. Okay, they were up 50% on their energy stocks. Morgan Stanley, Goldman Sachs, all bragging about, oh, we were so smart, we were up 50%. That's great. We were up 120% because we got in there early. And we saw the change when it was taking place. You're not going to get, again, those are on the longer term trades. But these are the types of situation. I think gold is in just beginning. We're in the early innings of a very, very big bull market in gold. And remember, buying GLD and such, it's fine, but the gold miners are very much leveraged, and the silver miners. So if gold goes up 30%, they're going to go up 90%. They're like three time leverage, depending on the company and stuff. I think inflation is going to continue to come down, but it's going to stabilize at a level that's higher than I think most people are thinking right now, and that's going to cause stagflation. And the gold is an unbelievable opportunity. I think it's one of the best plays. Now, one thing about gold, of course, is people say, "Oh, have 10% in gold." You want to be overweighted than the traditional 10% in gold, but you don't want 50% in gold either. It's such a concentrated asset class. So, but you still want to be overweighted, in my opinion. I think it's going to work out really well. But I do want to talk about a little bit about what I'm seeing, why I'm worried about. And again, this is a chart from the Maley report. Again, if you want to check it out, the MaleyReport.com, you get this weekend's edition for free. But here we are. We had a nice breakout. We were in that sideways range for a couple of weeks, 2 to 3 weeks. And I said, geez, if it breaks out to the upside, it's probably going to get right up to that 200-day moving average really quickly. Well, sure enough, that's exactly what has happened. But so it's bumping up against the 200-day moving average. See how it got slightly above? That's the purple line. I'm sorry. The purple line is the 200-day moving average. It got slightly above it here early in the bear market. Each time it failed. Then it got right up to it in August and failed. Got right up to it, actually slightly above it in November, December, failed. Now we're there again. Is it going to fail again? So in other words, But this is doubly important because not only is it the 200-day moving average, but it's also the trend line going back to the all-time highs. So right here at 4,000 is much more than just a round number. Now, the stock market is not really crazy overbought. It's about as overbought as it was in December, so it could roll over. But we want to see, now again, as always, we always want to do a technical analysis. If you break slightly above a resistance level or slightly below a support level, that doesn't mean anything. We get head fakes all the time. And look what happened here, right? It got slightly above it, rolled back over. Got very slightly above it, rolled back over. Okay, the same thing happened to the downside. It gets slightly below a support level and bounce right back. But if this becomes a more material break, all right, I'm going to have to shift gears and look for a run, probably up to the 4,200 level, or even a little higher. So I mean, here, we have obviously it's the 41 level. I think we'll break above that if we can break above that here. I strongly believe, again, for all the reasons I talked about before, the market cannot keep going up. It's just too expensive. Even if we avoid recession, even if inflation turns down, it's just we are in, and as I like to call it, the normalization process. When the market gets ridiculously overbought, ridiculously overvalued, like it did in 2000, every time in history, in 2000, and also in, of course, 2007, it takes more than the normal bear market to work it out. We get big bull market rallies in the middle of it. Big bear market rallies, and they fail. I strongly believe this one's going to fail too. No, bear markets do not bottom, okay, in the mid-teens. They bottom below 15 times earnings, okay? Every single one of them, at least since World War II anyway, the last 190 years. And again, because you have to de-risk and you have to de-leverage all that ridiculous amounts again, it's so similar. It wasn't the bubble wasn't as big as it was in 2000 because the liquidity wasn't in there. It was in there for 2 years instead of 5 years like it was, or 5 years or longer like it was in the 90s. But look at all those ridiculous companies that everybody said was changing the world. Most of them went out of business. The ones that survived did extremely well. And the ones that survived this time will do extremely well. That's why we want to be raising some cash on bounces like this, so we have money when the ultimate bottom comes. Because the next Amazon and the next Google, et cetera, we want to the ones that survive will be unbelievable, and there are plenty of them out there. And again, I'm not saying sell everything. I'm saying people should be nibbling on Google or Alphabet. Google is, of course, Alphabet is the name for the parent name company for Google. That stock is actually a cheap stock. Okay, it is trading now in the mid to upper teens. Mid-teens in terms of PE ratio. That's only been cheaper one other time. So you can nibble on that here. You don't want to back up the truck because you buy a little bit each month over the next year. Your average price is going to be great, but you don't. But Microsoft, it's a great company. It's not a cheap stock. Bear markets end when these stocks get cheap. Remember what happened. I'll get back to that later because I want to really concentrate on this thing with these indices right now. But here's the S&P 500, as I mentioned. We're at a key resistance level. If this thing fails here, which I think it very well could, we're going to be in for some real. So I'm going to be planning for bullish. Believe me, I'm not saying, hey, I'm turning bullish. I'm going to start buying calls hand over fist next week. Not at all. I just worry that it's not overbought and it could go up for another week or so. But with these earnings coming out, I think that'll change. Look at the NASDAQ. Yes, it has broken out of a very slightly of an. See the two yellow lines? That's what's called a descending triangle pattern. Okay, but just because it's a descending triangle, it can be broken into either way. It's being broken to the upside. The real resistance, the key resistance, is the 12,000 level, but it's breaking out. So that's another reason I'm thinking this could be that we could see a little bit more upside. However, you got to watch the 10,700, which is 260 on the QQQ, which is the ETF for the NASDAQ 100. And remember, for those who don't know, the NASDAQ 100 is the top 100 stocks in the NASDAQ composite. And it's mostly, it's heavily weighted with tech stocks. So it's a small composite, but it's one that a lot of people really follow on Wall Street. But anyway, 260 on the QQQ, which is 10,700. See how important support that is? It's bounced off it 3 times. If, and I think when it finally breaks that level, that's going to be really, really, really negative. Okay, it's going to tell us that a new leg of the bear market has begun. So, and I'm not, that doesn't happen. It may not happen for again. And the rollover may take place next week, but if it breaks below that level, it'll probably be several weeks from now or even a couple of months from now. But keep that, make sure you have that written down. 10,700 on the NDX NASDAQ 100 index. The QQQ, its ETF, the level is 260. You break below that, we're going to hit. Again, you have to do it. If it makes it breaks below it a few pennies, not a big deal. But this is what we're talking about. This is what we're talking about. And then the Russell 2000, we're bumping up against its highs from November and December. If it can break out from there, I will turn more bullish on a near-term basis. But as I said, I don't think it will last very long, and we'll try to take advantage of it if it does. If the facts change, we'll change. But once it runs its course, we'll be back in, because I do think that 2023 is going to be a very, very tough year.
And I want to give a quick shout out here. VJ Shola and Neurowave. Big shout out, new family members here in the house. Let's go.
Great to have you here. Thanks a lot. So let's give you another idea here. Now, here's one, and I've got to make sure that I had to run out not long after the market closed on Friday. Excuse me, just had a personal thing, a positive thing to take care of. Excuse me, I said it's father. But so I was trying to buy some puts in GE at the very end of the day, and I told him I was going to, and then my system froze, and I wasn't able to buy them. So but I had every intention in buying them. I did not buy them, but I will be buying them next week. So the point is, in other words, there are people in the chat room who I think did buy them. I was buying them. I had every intention of buying them. I wanted to buy them. And again, I did say we'll start a little bit now, and we'll order more next week. In fact, I got to make sure that the people know. I like to know that I would do it. But this is the reason why. GE, remember that RSI thing? Look how overbought it is. It's RSI, okay? Very overbought. See what happened the last two times? It got this overbought. Didn't even get that overbought the three times before that, and the stock got hit. Each time got hit hard. So this stock's getting ripe for a pullback. Now, but look at this. Look at the weekly RSI. Again, it's not quite as oversold it was in early 2020. I'm sorry, overbought. It's not quite as overbought as it was in March of last year, but it's getting there. Okay, it's really getting overbought. So now it's not only is it overbought on a short-term basis, it's overbought on an intermediate-term basis. And then something I'm going to go over here, and we'll look at this. We'll look at Bitcoin later. I'm sure people want to know what my thoughts on Bitcoin, but I also want to look at GE. We call the Bollinger Bands chart. And this one, talk about, again, this is another one we look at from time to time. And see here, let's make it easier. I just want it easier to see. I want to take these things down there. Okay, bang, and weekly. Okay. See how it's getting above that purple line? Okay, that means it's getting this is the weekly chart. Okay, this is the weekly Bollinger Bands chart. 2 standard deviations above its 20-week moving average. This gray line is the 20-week moving average, and it gets above the purple. That's more than 2 standard deviations above it. The green line, green line is 2 standard deviations below it. Not a purple, but it's getting well above it now. Well above it. Because a little above it, it can keep going up. But when it gets well above it, that's usually a good indicator. Nothing's perfect. The stock may go $10 higher next week. It's getting to the point where this stock is getting very overbought. So we have it overbought on its daily RSI, overbought on its weekly RSI. You can see very extended on its weekly Bollinger Bands chart. I think this stock has got to come down, and so we're going to be buying. Again, the people in the chat room, we own some puts there. I'll be buying some more next week. I just think this is a stock. No matter what happens in the overall market, whatever happens to the stock, maybe this, again, they're splitting up, but the split up into 3 different companies doesn't happen until next 2024. I don't see any new news that really account for this kind of great move. The stock's up 66% in the last 3.5 months. This is not a tech company. I mean, it's an old line. I mean, it's good. It used to be a great company. It's and the new CEO who I like, and I think is, I think the long-term prospects for the three separate companies are quite good. But 66% in a market that's been moving sideways since October. I mean, it's rallied more recently, but it bounced. It's been bouncing around since October. I just don't buy that there. So we're going to be looking at those GE puts again on Tuesday. Remember, tomorrow, Monday, the market's closed for Martin Luther King birthday holiday, but we'll be looking at that one. So that's another one to keep a close eye on as we move into next week. But overall, I think this year, 2023, as good as things look now, it's going to be a rough year because we still got a lot of the excesses that built up in 2021 are going to take longer than a year than the year we've had so far to unwind them.
Right, Matt. So we've definitely covered a lot of different sectors, and I think this kind of gives a little bit of a sense of what really goes down in the chat. Maybe we can take a couple of tickers.
Oop.
Yeah,
Did I lose you?
No, do you hear me?
Oh, okay. Sorry. Yeah. Yeah. Go ahead. Sorry about that.
Yeah, no, this microphone.
Who knows? But okay, you can hear me though, right?
Yes, I can. Yes, sorry.
Okay, cool. So Pharaoh, so yeah, when it comes to giving out actual like trade setups, Matt does that in the live room. However, I'll say last time we did one of these sessions, he bought those calls. He told everybody about Tesla, bought the calls. People that even bought it the day after made money. The mic is much better. I know.
SQQQ, we do cover the SQQQ.
Absolutely.
Matt Maley trades TQQQ, SQQQ, wheat, commodities, a lot of different things, right? So let me just go over some of these. Guys, post a couple tickers in the chat, post some questions. We'll pick some of these things out there. But
Right. You want me to? I just have. I'll to follow your lead, Rodrigo. But while they're doing that, do you want me to just touch on Bitcoin because obviously it's had a big bounce here recently?
Yeah, let's cover some Bitcoin, and that's kind of good to show everybody that you'll talk about everything, right? There's no.
Oh, absolutely. Let's look at. Well, I just want to see. Before I even do anything, because I want to make sure. And we all know how Bitcoin can move around quite a bit. I want to make sure I know where it is right now at this very second because it does not stop trading over the weekend. So yeah, 20,000. It's down very slightly, but it's had a nice run here. But I want to show you the situation we're facing right now with Bitcoin on a technical basis. It's just no matter how if you're one of those people who love Bitcoin, think it's going to 100,000, that's great. But near term, you need to be careful. It's had this huge run. Again, look how overbought it is on its RSI chart. Okay, and this you see how again now it has gotten this overbought and even more overbought in years past, but it hasn't in the last 2 years. So we need to be careful. It's above its 200-day moving average. Let's see. There's the trend line from the 2021 highs. It's broken above that. It's trying to test its highs from this October, but it looks like my guess it's got to take a breather here. So be careful about chasing Bitcoin right now. If you bought it recently and for a trade, you might want to take some profits. But the real point is I don't want to be chasing it here. And again, this is nothing to do with my longer term view. To be honest with you, my long term view, or at least intermediate term view, is that it still has to do with a liquidity based asset. No matter what its long terms are situation. So we need to be a little bit careful anyway. But this is just one is you I'm just very much afraid of chasing it. Now look at remember I talked about the Bollinger Bands chart. See, look how extended it is above. It's way more than two standard deviations above its 20-day moving average. Remember, that's the 20-day, not 20. Whoops. That's the 20-day, not the 200-day. But that green, see how extended it is? So it's very, very extended on its Bollinger Bands chart. And you can see it got up here, much more extended than it was here. And look what happened. It got absolutely hit. So we want to be very, very careful on a near-term basis on Bitcoin. And you don't have to be. That's the one thing is that people get caught up too much on the long-term view. especially in something as volatile as Bitcoin is, and all the other cryptocurrencies. I'm not, just because I'm saying this is I'm not. It doesn't mean the freaking guy hates Bitcoin. No, that's not what I'm saying. I'm just saying is that it's had a good run. It's at 20,000, got to 21,000 this weekend at one point. Can it go to this chart? I must admit, I drew up on. I drew up yesterday, but I'll pull it back up for you in a second. So, but you see how that got above 90? Could it get to 93? I mean, there were times when it got to 97, 98. I just don't see the enthusiasm right now for it to get that overbought. And so, again, it could get a little bit more here, but I don't think, is it going to 25,000? I guess my point is, I think you'll see it below 20,000 before it gets to 25,000, even if it's going to 25,000 by next Friday, a week from Friday. And 2 weeks, 3 weeks from now, it might be at 25,000 or 28,000. I think it's going to go to below 20,000 before it does that. Just again, I've been wrong before, I'll be wrong again, but I've been pretty good on Bitcoin. And I think this one, you just have to be careful. You can just see it. Picture's worth 1,000 words, and you see two of them. It's so very extended. Whoops. So very extended on both its Bollinger Bands chart and its RSI chart. Anyway, so I just wanted to point those out. At least on a near-term basis, we want to be a little careful there.
Right.
Yes.
Okay. Yeah. That's absolutely. And the thing is, Matt, you've been covering all this stuff for a while. So for the people that have been following you, they know how consistent you are with that. Let's see what other questions or tickers. All right. So Tanner is saying a cup and handle starting. That's good. Yes. I mean, Matt Maley covers technicals, patterns, all these sorts of things. Let's look at, well, folks, put up a couple tickers in the chat so that we can show you basically Matt Maley's, how he goes. Okay, so Crowlin, is that a ticker? SMH, or do you mean shaking my head?
Oh, SMH.
Yeah.
Well, I'll tell you what,
it is.
I have a pre-made chart on SMH, so I'm going to show you that. Let me blow it up so you can see it. Because it's the weekend, it's not trading. When we do it, like when I do it on the Tuesday Zoom calls, I just do the live chart because the market's open. It can move around. We don't want to. But here is one. Whoops. Here is one. Okay, great. Okay, so let's get here. So again, remember I talked about. Oh, jeez. Hey, I'm doing my Zoom thing. How about roast beef? Okay. That was my wife. Sorry about that. She was calling. She's texting me, said she was at the deli sandwich. She's going to try to get something for lunch. Anyway, so if anybody would like a roast beef sandwich, come over to my house. We're going to have some. So here we are at the SMH. And what the SMH, Semiconductor ETF, vitally important group because it is a clear leading indicator. I'm sorry, a clear leadership group for the market. And in fact, it sometimes it leads and so it moves in one direction or another before the rest of the market. Sometimes it moves coincident at the exact same time. It never, at least as far as I mean, I went back about 30 years. I can't find a time where an important move that the SMH or the semiconductor, you can only look at the SMH back about 12, 15 years. But if you look at the SOX semiconductor index, which is exactly the same thing, it goes back many. So if you want to do your own research, you can look at that. But my point is that the SMH never plays catch up to the S&P. The S&P, it either moves with the S&P or leads the S&P and never plays catch up to the S&P. So if there's a divergence between the S&P and the SMH, follow the SMH. That's where the S&P is going. Okay. But there's not always a divergence. Sometimes they move in tandem. Right now, so we had here, it's on a bullish way, a bullish situation here. Obviously, lousy year last year. It finally comes up, makes a slightly higher high, not an important one, but it did break out of its downward sloping trend channel. So that's good. It came back down. Remember, one thing to note for those who are new, whenever we look at support and resistance levels, whenever those levels are broken in a meaningful way, they flip-flop. In other words, an old support level becomes a new resistance level, and a new resistance level becomes a new support level. Well, sure enough, this trend line, or the upper line of this trend channel, was the old resistance. We broke out, came back down, retested it, actually fell slightly below it, but then regained it again. That's another bullish thing, So that old resistance became new support. It worked out pretty well. What's it going to do now? Is it going to break to a higher high? If it breaks to a higher high, like it is with the broad indices, I'm going to have to turn more constructive on a near-term basis over the next week or two to look for a further rally, probably up towards the 240 level. And so, maybe I'll look at some options in the SMH, but I'll also be looking at options in the individual stocks. Now, to be honest with you, the more I read about Taiwan Semiconductor last week, and the more I read this weekend, it's not. They reported last week. It was not a great report. The stock did rally, but I think it had more to do with the broad market rally, and then we can go into that. There's some talks about what really caused the market rally last week. Some the BOJ's injection of liquidity and some other things, but that probably won't be there for very long. But the point is that I think that we've got nothing but bad news from these stocks for several, or really for almost 6 months now. Is all the negative news out? I don't think so. I think it's going to fail here and roll back over. But if it breaks, I've got to stay nimble, right? And I've got to be willing to take advantage of a further rally before I reverse my bets, and before this thing, because if this thing was overbought, I'd say, hey, this thing's not going to break out here. It's gonna come up here, maybe get a little above it, and then crash, or then get hit. But it's not there yet. And you can see it could get more overbought. But again, back here, the Fed was still offering all sorts of liquidity. I don't think it's going to get as overbought as it did last year, because the Fed's not providing liquidity anymore. The best we can do is up here. So I think we probably get up to this, maybe slightly above it, and fail. So we'll see what happens. But right now, there's no question. I have to point out, even though I'm bearish on an intermediate and long-term basis, this is something I have to pay serious attention to, because this is a positive development and it's looking pretty good. So we'll look, but again, if it looks to break out, I'll be looking more at advanced micro devices. Nvidia's already had a big run. Look at some of the ones that are still beaten up. They've all lifted, of course, in the last several months, but see ones that are a little bit further down, where Nvidia's had a big run here. Advanced Micro, Texas Instruments, Intel. There's some others I'll look at to buy some call options if it can break a D above. I used to know how to talk. If it can break above that resistance level, and let me just and again, it's just at above about 230 on the SMH. Okay. Oops.
Right. Yeah. Good stuff with the SMH here. Let me see what else I can find here. So we went over SPY already. SMH. Everybody wants to know about the SMH.
Well, let's look at just, since if anybody else will put some other ones in there, Bitcoin. Well, we just did Bitcoin. I'm sorry, okay, and I want to do Microsoft too. But see how Advanced Micro again. It made a higher low. That's great. And it's trying to get above its 50-day moving average, which is the yellow line. A little overbought. INTC, Intel. It's like a lot of people don't like Intel. I like it long term for some variety of reasons. But see, this one's getting overbought, and it's bumping up against. Let's get rid of some of these lines so you can see it a little bit better. Intel. See, Intel's getting quite overbought. I don't want to be chasing Intel. That's not a good one. Nvidia is kind of the same way.
Yeah, Netflix is coming up there.
Okay, Netflix. That's another. And Nvidia is not quite as overbought. Trying to get it, but and I'm worried. The more I think about this SMH, the more I watch this SMH, I think there's a good chance it's going to fail at these levels. But if it breaks out, we're going to have to take a look at these. And we're going to have to take a look at some positive names. Now,
right?
Netflix. I'm sorry. Did you say Netflix? I'm sorry, bud.
Yeah, there was Netflix, and then we got, after that we'll do Boyle for the
Yes.
good brother here, Wasif.
Yes. Okay. Netflix. Look how overbought it is. It's not crazy overbought. Now, again, there's been a lot of good news. I don't want to Okay. The purple line, it's its 200-day moving average. Let's go back. Let's go 06 2020. Oops. 2021. Okay, here we are. Now, look at this. This stock looks great since early last summer. Higher, little minor ones, higher high, only minor one, but a higher higher low. It traded sideways. Higher high, higher low, higher, very minor higher high, higher low. Another very minor higher high, but higher low. Another very minor, but it's getting overbought. Okay, so it looks like it's getting ready for a pullback here. but but there's no question that its trajectory is really nice. And of course, if you draw the if you draw its trend line, I mean, it's way above its trend line. I mean, this trend line, it's been way above its trend line for a long time. You really have to try it from to here. See, I mean, just by moving sideways. It's good when something breaks above a trend line by moving sideways, but when it starts to move up, this is positive. But I just worry that it's getting again, it's getting overbought. Let's look at the one thing though too that we do have to worry about here. It's starting to get overbought on its weekly RSI as well. So you're going to be a little bit careful there, but it's not overbought. But again, I don't think because we don't have the amount of liquidity in the marketplace that we had before, it's not going to get up here. But be a little careful. Be a little careful on Netflix, at least on a short-term basis. But there's no question that this is a very nice long-term chart. I just want to look at one other thing here. And like I said, there are things. Sorry. Equity. Okay. Okay. Now it's kind of funny because look at this thing. Talk about differences. It's trading at 30 times earnings. That's obviously above a market multiple, but maybe they're the best. They're the best. You got to be careful. I'm worried about this one in terms of because the overall market, I think it will probably come back down. But the stuff that was just kicking the snot out of the stock last year is not something that's is not something I think is going to happen again. It will go down if the broad market goes down, like I think the broad market will. But I think that it's a stock that is not going to underperform like it did last year. Now, Boyle. Boy, it's funny. I've been, we bought it before. Hold on a second here. And we got stopped out. It's getting knocked down with this whole thing, the warm weather. I mean, they're going to be in Davos. They're going to be in Davos this week. I'm sure CNBC and Bloomberg, all those guys are going to be doing broadcasting from there, which they should be. But did you see the news? They said they had 2,000. I forget the numbers. It was 2,200 people going, and they had 2,000 private jets. So it's like their concerns over the environment aren't quite what they should be. But anyway, but there's no snow out there. You're going to see that there's no snow out there, and Europe is still very, very warm. And let's look at. I'm going to come back to that. Don't worry. I'm going to come back to Boyle. By the way, for those who don't know, Boyle BOIL is the 3-time leverage ETF for natural gas. Hold on. So here is natural gas. Let's look at the commodity. Here's the chart on natural gas. And boom. See how it's oversold? It's getting quite oversold. It's trying to stabilize. Okay, got hit on Friday. People bought the cold KOLD, which was the leveraged negative thing ETF for natural gas. But see, it's trying to stabilize here, and it's oversold. It's oversold for a while. Let's look at the weekly. Oops, wrong. Oops. I have a couple things on my screen that you can't see that make it hard for me to see my own screen. Hold on here. Jeez. Here we go. I apologize. There. Come on. Talk to me, Goose. There we go. See how it's getting oversold now on its okay. So here's a couple of reasons to start thinking about. Again, I've been looking at the sentiment readings on natural gas. It's getting negative, but I'd love to get it just a little bit more negative. Boy, if you get one more, it's going to be one more dip. It's going to be a screaming buy. But look at this thing. Let's go back. I'm going to go all the way back to here. Let's see what it looks like here. Okay, it's really slow. I'm sorry, but not sure why it's not updating. But you can see this is the. Okay, there we go. Okay. Well, actually, that's trade. Well, that we were, here was a bear market, obviously, for natural gas. Okay, but let's just go. I keep giving these dings because everybody wants their lunch orders, I guess. But here it is, oversold on its RSI, and testing its 200-week moving average. Now that provided good support back in here when we were finally moving into the bull market. If we're still in a bull market for commodities, and I think we are, and with the dollar coming down, what we talked about earlier, that should be bullish for it, and it's finally getting oversold. Let's look at natural gas on the Bollinger Bands chart real quick. And but my point is that I want to be buying oil soon. I've been holding off, and I'm going. I'm going to hold off a little bit longer. I started. What is wrong with this thing? Let me go back. Hold on a second. NG1. Currency. BOLL. Okay. Now that is, see, it's not oversold on its Bollinger Bands, but what about its weekly? And there it is. It is oversold. See how it got down to that Bollinger, rallied there. See how it got down to the bottom line of its Bollinger Band, rallied there. It took a couple of weeks, so it may take a little bit longer, but boy, it's getting there. And I got these readings from the futures traders. If that really turns negative, I'm going to be wanting to buy oil because I think natural gas is going to turn around quite nicely, and the weekly dollar should help.
And Dylan's been very patient here asking about Morgan Stanley. Maybe you can give us an overview as well of the investment banking sector.
Yes, here. They report next week, and I just want to make sure which day. Yeah, they report Tuesday, 7:30. So it looks like it's before the opening on Tuesday. Remember, the market's closed in the U.S. on Monday. So just remember that. So a couple things. I am, it's a great company, and the CEO used to work at Merrill Lynch when I was there. He was not in my area, but a very, very, very well-respected man. Good Aussie. And he's done a great job at Morgan Stanley. Now, the one thing that, and I'm going to show you, there's some positives and some negatives. And you guys on the technical side of, well, let me talk about the fundamental side of things first. Fundamentally, they're laying off people. Goldman's laying off people. They're the two. JP Morgan's laid off. Everybody's laying off people. Almost everybody's laying off people. And they're, the one thing to cut bonuses. When they cut their bonus pools, that's kind of backward looking. But what they're doing now though is that some people aren't getting any bonuses at all. They're hoping those people will leave. You know why? Because they're going to lay off more people in March. I'm telling you right now. I've been seeing these cycles a million times. I've seen it happen. They said they give lousy bonuses at the end of the year and they lay off some people. But what they really hope to do is that a bunch of people will leave and get a job somewhere else. The problem is they're all doing it at the same time. So people can't get a job somewhere else. So they stay, and then March comes along and they say, okay, we're laying off. I'm telling you right now, the managers at all those firms are making a list of who they're going to lay off sometime in February or March. I can't even tell you how I've seen it so many different times. And of course, what they're talking about, the banks last week adding to their loan loss reserves. People say, oh, maybe the banks are wrong. Banks aren't wrong when they do these things. When they lay off people and add to loan loss reserves, they have the best view of the world. They see all what's going on. Not every business sees what's going on in the entire world. They do, and they would not be laying these people. They might lay off too many people, and they may take on loan loss reserves a little too aggressively. But they're never wrong. Okay, they may be wrong in the amplitude, but not in the exact direction. And so that's a concern. So what we're going to look for. Morgan Stanley, again, very, very good company, great long-term holding. They report. So we'll see what happens when they report. But look how this. See the 200-day moving average, tough resistance, got above it, but couldn't break meaningfully above it, finally did. And then so that old resistance became new support. We came down and tested that and held it. That's very bullish. And here we have a situation where you had a nice move here, higher low, higher high, but only a very slight one, but a very nice higher, another higher low. Can this make a higher high? If it can break above 95, it's going to be very, very bullish. I don't think it does. I think it breaks below its 200. So what we're looking at right now, you're looking at 95. You break above 95, you want to be buying calls in this stock because it's going to see a nice run. Again, has to be better than this $95.15. It's got to be a meaningful move, usually 1 to 2% above that level, and then it's going to run. If it's not, then we're looking at the 200-day moving average. Right now, that's 84, and it's flattening out, so it'll probably stay around 84 for a while. If it breaks below that level, it's going to be a problem. Stock's getting overbought on its RSI. Its MACD chart. I didn't even talk about the MACD, which I usually do, but this has to do with the change in momentum. It doesn't show tops and bottoms. It shows a change in momentum. You can see how it broke up to the upside, but let's see if it rolls back over. You can see how it can, it can make a couple of head fakes. It came very close a couple of times. But my point is, going back to the RSI chart, relative strength index, I just think the announcement they made on the fundamental side of things tells us that the stock is probably going to roll back over. But I want to remain nimble, and I got to change if it changes. If it trades above 95, I'm going to get more bullish. And if it trades below that 200-day moving average at 84, I'm going to get much more bearish. And again, the chances of it breaking down are a little bit higher because the stock is overbought. But again, let me go back to that one thing on Microsoft. Morgan Stanley is a great company, and you want to own that stock on a long-term basis. I just think you'll be able to buy it cheaper at some point. But it's just like Microsoft. Microsoft is a great company, but its stock is not a great stock right now. Its stock is still expensive. I know some people try to say it's not at 25 times earnings, but it is. Okay, that you just look back in history, it usually drops into the teens before it bounces, before it bottoms in a bear market. Now, what we're looking at here, and it goes back, and I'll just go, I don't forget about the chart on Microsoft for a second. One of the best calls I've ever made was in Thanksgiving of last year, not this, 2021, a year and a half, just over a year ago, 2021, and Sajay Nadella, the CEO, sold 2/3 of his personal stock. $274 million of stock. He sold half of it right before Thanksgiving, and a bunch more just after Thanksgiving. Combined 2/3 of his holdings, $274 million. Insider selling. There's nothing wrong with what he did. He is a great CEO. He's turned the company around. He's not, this was not something he pushed the stock up by giving false pretenses about their company. Nothing. He told the truth all the time. He turned that company was an unbelievable company. It went through a decade of tough times. He came back in and saved it. After Bill Gates left, they had a 8 to 10 year drop. He came in, he's taken it back up it's a great company. He's done an unbelievable job. He deserves all the money he's made. But he saw what was happening last year. He saw what the Fed was going to do. He saw that his stock was way too expensive. And even though it remained a great company and remains a great company to this day, he sold his stock. And you don't sell your stock. You don't sell that much. You think the stock's going to go down 10 or 20% and bounce right back, which it had done many, many times in the past decade. You only sell that much if you think it's going to go down and stay down, okay, for a couple of years. And sure enough, it's been years. He saved himself $125 million by doing that. He's a smart guy. Okay, what did he do 2 weeks ago? He came out and said, we're facing 2 more years of serious headwinds in the technology sector, in his sector, cloud computing, et cetera. And they were talking about cloud computing being something that wouldn't get any weaker in an economic downturn. He said just the opposite. When he is so good, and again, there's nothing, he did nothing unethically wrong by selling that stock. He had every right to do it, and he's the reason the stock went up a lot. The thing is, he realized that the Fed's liquidity pushed it to a level that was even more than he had been able to do, and it was too much, and so he sold some stock. Now he's still giving us warnings. So he's not, as far as I know, he's not selling more stock. But when you already have that much money in the bank, he's if anything, he's getting stock. His year of bonus involved more stock, so he probably has a bigger holding than he used to. But now it's at much cheaper prices. But when a guy like that says these things, you've got to be very, very careful. So, but again, we can look at it here. The purple line is the 200-day moving average. And that's a level we want to keep an eye on. If it can break above that, it's still a long ways away from that. If it can break above that, it's going to be quite bullish. But if it breaks below this 220 level in a more significant way than it did in November, we got problems.
Right. No, well, I mean, you're absolutely right and on point with all these things, Matt. Of course, we've tried to pack as much as we can in this short session, but for those that do want to trade with you actively, you have your live room, you have your Tuesday meeting, and all these other trade alerts that go out to the members. What would you say here? would be, why should why should people watching here join the chat room and trade with you here, Matt?
Well, I mean, it's just two things that stand out. Number one, it goes back to what I said before. Well, I'm going to save that one for a second. The first one I say is that 2023 is going to be another very volatile year. And as much as people keep trying to say they're really smart people, but they think we can go back to what we've had the last decade. The free money era is over. We are in a valuation compression period. I call it valuation normalization. Okay, the interest rates were pushed to an abnormally low level. If we go into a recession and rates come back down, they're not going to go all the way back down to that zero level that provides all that added speculation and fraud. They're not going to do QE. They're still doing QT. They're draining draining liquidity from the system, not adding to it. And even if they stop QT, they're not going to go to QE unless we have a major break in the market. If something breaks like it did in 2018 when the high yield market broke down, they had to do a quick pivot and completely reverse things. Again, if that happens, that's great. That will be bullish. The problem is when it breaks, the market's going to crash, get smacked hard, and the market will go down a lot before the Fed can pivot. So that's not a reason to be bullish. So the point is 2023 is going to be another volatile year, just like it is and coming out of the last time they added all the liquidity in the late 1990s. We're going to see it's going to be a 2-year process before we listen to what Mr. Nadella says from Microsoft. 2 more years of headwinds. We got to be able to take advantage of that. Don't be the people that just sit there and watch their portfolio get annihilated in another year. We might see more upside on the near-term basis, but we're going back down, and I think we're going to lower lows, and I think we're heading to the low 3000s in the S&P. And if you're an active trader, you're going to be able to make money instead of lose money, and that's going to give you the unbelievable confidence to buy when there's blood in the streets, like there was in 2003 and 2009. And while everybody else was in 2004 and 2010, most people were every bounce. They're like, "Oh, great, I'll sell a little bit." The guys who had some money on the sidelines, they were still buying, and they wrote it. It was a great opportunity to buy. So that's one of the reasons here. Be with people that can help you trade in volatile times. But the most important reason is trading alone is so hard. It's so hard. The best traders in the world, the ones who do it at the best hedge funds and the best mutual funds or whatever it happens to be, they don't trade alone. Why would you? And it's a great team of people. We're helping each other all the time. It's not all my ideas. Believe me, there's some great ideas from other people every day. And I mean, that whole thing with GE that I highlighted and see it's incredibly overbought. I didn't notice that. It was one of the people in the chat room who said, "Hey, Matt, what about GE? It looks a little overbought." I was like, "Oh my gosh, that was his idea. Not mine." So people help you too. It's like, "Hey, what about this? What about that?" And even if you say, "Hey, I'm in this platform. Should I be using another trading platform?" And people help each other out with that. It's trading alone is all but impossible. The biggest and the best don't do it. Why should you? So I hope you'll join us. We have a lot of fun too. We can kid around with each other a lot and have a good time. But it's going to be another challenging year. But we had a great year last year. I showed you all these trades. We had very nice performance last year. Made money when people were losing a lot of money, and we want to do the same thing this year. So I hope you'll take a look. And thanks a lot, Rodrigo. Always great. We'll see you in the chat room and see you everybody in the chat room again tomorrow. The market's closed in the U.S., so we won't be there. Although I'll be in there, maybe making a few comments. I definitely want to make sure that people in the chat room know that I was unable to buy those GE puts, but I will be buying them next week. But anyway, see you then, and enjoy the rest of the weekend.
All right, so I'm going to show everybody here the live room with Matt Maley. Again, Matt, thanks a lot for being here. Thanks a lot for your time. Let's go ahead and give a proper shout out to Matt Maley. Proper shout out. Let's go.
Great,
all right, Matt.
We'll talk to you real soon.
In the chat room.
Okay.
All right, folks. That's Matt Maley, Chief Market Strategist at Miller Tabak. We were only here for about 2 hours, but he's there in the live room Monday to Friday, 8 a.m. to 5 p.m. The live room is open 24/7, and I'm going to show you here, if you can see, how the trades are structured, how Matt Maley will post entries and exits and that sort of stuff. So really quick, for those that just joined here, The live room with Matt has 3 to 5 daily trade alerts in the live room, which is open 8 to 5 p.m. Eastern. Then you have a meeting every Tuesday from 11:30 till about 12:30, just for the chat members, where you do trade adjustments, market updates, a whole bunch of other stuff, education. And then you get 6 email stock swing trade alerts per month. Those are sent to your email. So you should be looking them in your email, but you also have access to them in this platform. Let me show it to you here really quick. So you go to the dashboard and you can see the charts, how they're posted. Let's wait for this to load up basically here. You have a calendar with all the important things that are happening, very important. Your agenda, right? You have a chart system here as well. You have all the updates on the trades, entry, target price, stop loss. So you have all these things available in the dashboard. The other thing I do want to mention here is that you do have push notifications available in the chat room. So if you do download the chat room and you go to the Play Store or Apple Store, whatever you have, you download the Benzinga app, you get in with your credentials, and then you will automatically get push notifications on every entry, every exit that Matt Maley is doing. Let me show you what exactly you would be getting. So you have 2 channels. Tim, for all the people that just joined, pay attention. You have the Inner Circle chat. That's one channel. That's where everybody, including Matt, is having a conversation, right? This is where we all gather, we all meet, we all talk. And everybody can have a full, we got James Donahue in the house. James Donahue also helps a lot of the new members. And let's see who else we got here. So James has been going at it here. Again, this is, people are here on the weekends. It's open Saturdays, Sundays. It's not like it closes. The only thing is that Matt Maley is only there from 8 a.m. till 5 p.m. Monday to Friday. So you have a full conversation here with all the folks. The actual push notifications that you'll get are the ones that are here, right? And you can enable sound alerts by clicking on that bell if you have the windows open. But if you do not have the windows open and you have your phone and you're logged in with your Benzinga app, you will get a push notifications for every post that Matt does in that chat room. Like if he's buying more of the TQQQ January puts, or if he's adding to the Bank of America January $34 puts. These are from last Thursday, but you can see that everything here has a clear entry exit of what he's doing, the contract that he's buying, expiration date, strike price, and if it's a call or a put, and the symbol, of course. So this is as simple as it can get, folks. Whenever it comes to trading, all you have to do is mirror the trades. You can see here that Matt was letting y'all know that he was going to be on Yahoo Finance Network, and he's all over the place. I know I just say CNBC and Bloomberg, but he's all out there. He's even in some other channels in Europe and some other network. I don't remember what's the name of it, but he's all out there basically. So you'll see a lot of Matt Maley, and that's very important, right? When you have all these gurus out there, you actually have a certified professional trader, chief market strategist, someone that's been head of trading, someone that's been director of trading at some of the largest institutions out there, including Merrill Lynch. So it's not some self-taught retail trader. It's not somebody to tell you go buy AMC and GameStop. There's an actual strategy here to what Matt is doing. And we did cover some of those trades. Sorry. What? All right. We did cover some of those trades with Matt. We wanted to show you some of his strategy, some of the trades that he's used his strategy on. If anybody does have questions or anything like that for the particular chat room with Matt, please send an email. The discount is already applied on the checkout, so you don't have to do anything. It'll be applied right there if you do want to do an annual or the lifetime, which saves you money down the road, of course, if you're serious about trading. Everything that you have here, okay? You have the dashboard. You also have access to the recordings that Matt is doing on Tuesdays. So you can see, the recordings are going to be posted here. So if for any reason you miss it, you always have the chance to get back on it, right? Ideally, if you want to get on live, you can do that. But if you're not able to be there live, we do have we do have the recordings available for all y'all. So B. Edmund says, does Matt only trade calls and puts? Does he trade covered calls or use more advanced option strategies? Great question, Mr. Edmonds, or Miss Edmonds, I don't know. Yes, Matt Maley only does calls and puts. That's basically what he sticks to. He's not doing covered calls, credit put spreads, iron condors. He just trades the volatility. So whenever you hear about, Fed meetings and CPI or PPI numbers, retail numbers, I know somebody was asking about that. All of those events bring volatility with them. It brings a lot of traders that are specifically volatility traders. So whenever these events happen, we're pretty much setting up trades. So if we're in a Fed meeting or we have something coming out of the Fed, trust me, we will already be positioned and have a strategy for it. We do it every day, but whenever there's an event, we always try to take advantage of that volatility. That is what we're doing in the chat room. That's why we're not doing spreads or condors. He might do a straddle here and there. I've seen him do that, but for the most part, you're looking at calls and puts, short-term expiration. We're not buying calls 2-3 months out. The majority of you guys here, I think, are trading in that manner where you're buying calls and puts short-term, just like you would be trading a stock, only that you do it with the options to get more leverage, right? And pretty much put less capital up front for the trade. Instead of buying 100 TQQQ calls, you can buy a couple of contracts and you don't have to put that much up front. So that's another benefit of using options. The other thing is that you do have immediate feedback and questions that you can ask Matt Maley, a chief market strategist. If you do want to add something into the session on Tuesday, you can do it. We cover a lot of different things on that Tuesday session, including market analysis, trade adjustments, sector analysis, Fed meeting discussions, strategies that we're going to do for the week. And also we explain what is happening and why Matt is doing what he's doing. So you can see here that it's pretty much ongoing. This is from today, right? You can see that everybody's been there in the chat room. So this is open all day. The other channel, Matt's important messages. This is where he's posting entries, exits, market commentaries, all that sort of stuff. As you can see, here's the reminder. Our regular Tuesday Zoom call will begin at 11:30. So he's letting you know, when we're going to be having that call. Again, here, buying some Verizon puts here before the close. Very overbought on the RSI chart. This is a lesson of itself. Why is he doing that trade? He's telling you right here. We covered the RSI today. We did a lesson on technicals, moving averages, market overview, global markets. We covered a lot today. This is more or less how the conversation goes when he's doing the Tuesday sessions, right? So, folks, I think we did cover everything here as far as the live room. Edmonds, good question there. If anybody does have questions, y'all know where to reach out. A big shout out to all y'all that were here. Wasif, I got your email. I'll reach out to you. It's been great being here with you guys. Appreciate you guys being here, participating, attending, getting a head start on the week, right? It's very important to get a head start before Monday, especially with somebody like Matt. Deborah Colony, good to see you. Good to see you here again. So, folks, everybody, big shout out to all y'all. Thanks for being here. I'm going to see y'all in the chat room tomorrow. So make sure that you got everything set up. If you do have questions, you know where to reach out. Have a great day, folks. Edmonds, the cost is the same when you renew next year. It's not going to change. We're not going to pull the Comcast move. So whatever it is today with the discount, it's already applied on the checkout. If it's annual, it renews at the same price. If it's lifetime, it never renews. Everything's on the checkout. Good to see y'all. Have a great day, and we'll see you in the chat room tomorrow, folks. Let's go.